Published 3:19 Eastern Daylight Saving Time, the 25th of October 2018. Updated 3:19 Eastern Daylight Saving Time, the 25th of October 2018. Donald Trump's trade war, the Fed going loco with rate rises, Italy's intransigence, or the concentric circles of Brexit. There are plenty of things to blame for stock markets sliding. Whichever villain you choose, and it may be some, all, or none of these, there's a shift in the stock market music worth noting. The FTSE All Share Index, a broad measure of the UK market, has dropped 6% since the start of October and is down 10% on its peak in spring this year. The FTSE All Share Index has taken a tumble this year, and investors are worried that markets may have further to fall. But for investors looking at their portfolios, there will be many shares deeper into the red than that. The pain is exacerbated by the fact that some companies nursing the biggest falls are those that have previously done well for stock pickers. To name but a few, house builders big and small, EasyJet, Just Eat, Superdry, Purple Bricks and Fevertree have all seen hefty double-digit or greater percentage falls from their peaks. Understandably, this kind of scenario gets investors wondering whether things will get even worse. Fueling their anxiety is the concern that a big tumble is made more likely by the unusual length of the bull market since the financial crisis crash and the infrequency of corrections in recent years. Unfortunately, accurately predicting the future is not a skill many of us have. This could simply be a correction, with investors still hungry enough to buy back in and send shares back on the rise, delivering what gets dubbed the final melt-up phase in a bull market before the inevitable big falls come. The argument for that hinges around the lack so far of a final euphoric leg up, when everyone is buying in on the belief they'll get rich. For a recent example of how this works, just look at Bitcoin at the end of 2017, but then perhaps things could be different this time, and our weird world of low rates and money printing means we've already had the best of the stock market run and the big falls will come without widely noticeable euphoria. What can investors do in stormy markets? One option is to look for funds that offer some protection and some even rose in 2008. So what can we do as investors if this kind of thing worries us? One option is to adopt the Buffett mantra of being greedy when others are fearful and buy more while the stock market is on sale. Understandably, if your worry is that shares will suffer a 30% fall and we're only down 10% now, this may not be your chosen course of action. Instead, you could look at shifting your investing style to adapt to a more volatile world. Traditionally, the way of doing this would be to up your bond exposure, and a cheap, easy, passive option for that would be a Vanguard Life Strategy Fund. Further up the bonds to shares scale. But the bond market is a dangerous place to tread, thanks to mass purchases through quantitative easing warping prices, so I'd prefer an active approach. Working on the basis that I'd still want to be holding shares for their better chance of a higher total return, my thoughts are that it's best to hunt in two areas. Managers backing things that are cheaper, with a value or contrarian stance, thus providing some insulation against the disappointment that can send highly rated growth stocks crashing. Funds or investment trusts with a defensive outlook. Among these on my list to consider are personal assets, which I bought earlier this year and we look at here, and rougher, capital gearing and RIT Capital Partners investment trusts, while on the fund side, those such as Baillie Gifford's Managed Fund, Premier's Multi-Asset Growth. All of these trusts and funds adopt a cautious approach, balancing their investment in shares around the world with bonds and other assets that should bolster performance when the going gets tough. None are likely to match the stock market's performance over recent years, when conditions have been benign, but they do tend to have enviable records when markets fall. Capital gearing, for example, made money in 2008 at the height of the financial crisis, while personal assets fell just 3.4% that year before rising 19.4% in 2009, and says its investment policy is to protect and increase, in that order, the value of shareholders' funds per share. Over the long term, Ruffer managed to position itself to not only dodge the stock market falls of 2008 but rise 23% that year, by holding a large amount of the portfolio in index-linked bonds. That same trick may not be possible again, but I am interviewing one of Ruffer's managers, Duncan McInnes, for This Is Money's Investing Show videos next week, so we'll ask him how it is protecting itself now, and you can watch the interview soon. The other option, and my main one so far, is to keep it simple and counterweight my share investments with some cash, the advantage of this being that it will be there ready and waiting for you if the market does take a big fall and you're brave enough to buy where others fear to tread.